Now let's talk about the difference between the Macau exchange that we are proposing here against the traditional exchanges. There are some pretty significant differences. Traditional exchanges, whether that's NYSE or Hong Kong Exchange or Shanghai or Shenzhen, largely that's where you raise equity. That's where you list and go IPO by selling your equity. Your equity is essentially a future profit of your company times a multiple of price earnings multiple that investors are willing to pay to buy the continued cash flow. So that's really all. Some of the exchanges also allow people to list and their debt instrument or bond, and there are exchanges like a CME, who is largely a derivative exchange that allows people to trade futures, whether that's commodity futures or financial futures. Against all of those traditional exchanges, MicroConnect Macau Exchange is essentially trading a complete new asset class, and we call that DRO, Daily Revenue Obligations. Three words are all important. It's daily, it's directly from top-line revenue, and it's obligation derived from a commercial contracts under Chinese law. So that's really essentially here we are talking about franchisors who offer to sell a portion, agreed percentage of revenue from their existing operating shops in exchange for funding for them to potentially open new shops here. So it's a financial swap, so to speak. But essentially, what the investor purchased is the entitlement to receive daily collected revenues, from those shops that are operated by the franchisor, and it is the arm or the automated repayment mechanism that is embedded in the system that allow us to collect on a daily basis. So it's a completely new asset class, and it's a complete new phenomena, and it's very, very different from traditional exchanges. That's the underlying is different. Now the second difference is the form of listing, and the frequency or the number are quite different. In traditional exchanges, taking Hong Kong Exchange as example, every year over 100, occasionally 200 companies will come to list. And when they list, each will on average raise hundreds of millions of Hong Kong dollars and occasionally billions of Hong Kong dollars. So in aggregate, the whole market would raise somewhere around 100 billion to 400 billion Hong Kong dollar funding every year. In contrast, MicroConnect Macau Exchange is likely in the future to host tens of thousands and possibly even 100,000 stores over a year's span to come to the market to raise funding, and each probably raising just hundreds of thousands of yuan. So the base number is substantially larger than traditional market, but the average size of funding they raise in this market is substantially smaller. But given time, both type of market will equally be extraordinarily useful for the financial, for the real economy. And we, fully expect that MicroConnect Macau Exchange in a few years will be able to allow the market to raise just as much, if not more, funding each year than the traditional exchanges that we see in the region. And that's a very good thing, because that we allow the central market of our financial system to allow a lot more inclusive, a lot larger number of smaller players who are able to raise capital and to be able to do what they do in the real economy. So that's a second big difference. The third big difference is traditional market is all about trading, because exchange is really located and positioned only in a very narrow segment of the value chain, but it's a very high value chain. When the company is growing, the company is getting bigger and bigger, is going through high schools and going through primary and high schools and colleges, the exchange don't really need them, and they are really not eligible. Only when they become big enough and suitable enough with a good track record and then meet the criteria of listing, and then the exchange will entertain their listing applications, and then they become listed. And then when they raise the funding, they're gone. The exchange is not in charge of dividend payment, other exit of the investors. Everything is just done either on the market or off the market through the systems. But the exchange is largely, once the funding is raised, the traditional exchanges is all about the trading in the secondary market of the shares that were issued, in the IPO or in the subsequent offerings. So it is the velocity of trading that drives the revenue of traditional exchanges, and the stocks are trading because people using different strategies come in and out of the stocks, and then the market provides tremendously important value in liquidity and in price discovery. In contrast, MicroConnect Macau Exchange is not about secondary market trading. It's about investment. It's about raising funding, and is about full value chain services. Because in this model, the exchange touches from the birth of that obligation, which is the commercial contract under Chinese law, and collect the money every day throughout the life cycle of that shop's contracts, and distribute that cash flow to the investors who are the beneficial owners of that entitlement of that DRO until the obligation expires and the contract is over and they start again. That's another life, that's another listing. So therefore, this exchange is not about trading, because secondary market trading of individual store revenue are highly unlikely, and if they do happen, it will be extremely low frequency. However, the exchange makes the money and contribute the value by essentially be responsible for the entire life cycle of any instrument from the day they're created until the day they expire. And the exchange is intimately and critically involved in every step of the way, and obviously that services in every step of the way drives the revenue and the future value of this exchange. That's the third important difference. And the last important difference is that in traditional exchange, the stock price or the investment is essentially made based on a stock price. And the stock price essentially is the profit of a company times the PE multiples that investors are willing to pay for that. So as a result, what impacts the most on the prices is the multiples. Because investors, if they are all optimistic, feel good about the market, they're willing to pay a significant multiple on the same stock. When they were pessimistic, everybody's trying to get X out and run out of that stock, and obviously the multiple that investor ultimately willing to pay for that is decreasing dramatically. That's why sentiment and momentum in traditional market really drives up and down stock prices in a very big way. The difference of this MicroConnect Macau Exchange is that the underlying assets here, that you actually don't pay premium, you pay at cost. Whatever investment you made, it is the size of the investment that determines the cash flow, the returns that are coming out of it. So there's no point trading that in the secondary market, because there's no such a thing about price premium or discount. It just basically returns on the investment. So this is really bring finance back to its basics, back to its essence, and back to discounted cash flow. And that's what finance should have been in the first place. It's just in the past, in the absence of digital ability to collect the daily revenues, we are not able to do that. So That's why we have the traditional exchanges the way it has been operating successfully so for centuries and decades and centuries. But now with China's consumer business becoming so successful in digitalizing itself and largely a cashless society, we are finally able to do things differently and probably in a way that is better.